Welcome to our weekly market review. It's brought to you by ETM Analytics and Treasury One. This week, I'm joined by Treasury One's head of market risk, Wichard Cilliers. Wichard, taking a look back, the Federal Reserve doing exactly what markets expected it to. They cut for the first time in 2025 to 25 basis points down on the rates. And this comes even though inflation remains well above its target. However, the labor data and that massive correction from a couple of weeks ago, by the way, that correction that happened in the labor data is equivalent to other corrections that happened in previous recessions, which raises very interesting questions around that. But that's really been the central focus, or is now the central focus of the Federal Reserve, is what's happening in the labor market and the implications there are for the economy at large. And obviously, when we see these recession indicators, red flags going off, we are seeing the marks in the labor data. It's easy to understand why the forward comment that came with last week's decision is hinting to more cuts to come.
Yeah, good morning, Ilze-Marie. Thanks for that. So Jerome Powell, they cut for the first time in 2025. One of the members, which was appointed by Mr. Trump, wanted 50 basis points cut, and he wants 5 more cuts for this year, but that's as a side note. So the most interesting thing about the cut that they said was Jerome Powell's comments afterwards. They say they still expect inflation to maybe kick up higher because of tariffs, but they expect unemployment. So they've got this conundrum of high inflation and unemployment, the labor market that's in a conundrum. That's nothing else than stagflation that they're talking about, just in different words. So the market at this moment, like I said on the graph here, is pricing for more cuts. At the moment, the white line there is where the Federal Reserve is, and the blue line is where they expect rates to be, and that's still 100 basis points away from each other. So that points to 4 more cuts, although the market is only expecting to cut 3 more times at each of the next things. Obviously, there's a few scenarios that can play out as well. If inflation comes out higher, then they're going to stop cutting. If the labor market falls off a cliff, they're going to cut deeper. So it's a bit of they call it data dependence from the Fed they're seeing again. So we'll need to see how it plays out. All we know is we're in for interesting times at this stage, and previously said the interest rate market definitely drives the rest of the world at this stage.
And what makes this particularly difficult for the Fed is the impact that AI is having, because we can see massive layoffs and labor data, weaker labor data coming out without the equivalent production cuts or output of manufacturing companies, because AI is replacing, and so the companies keep on going. So I think there's a lot of distortion. Plus the quantitative easing and tightening cycles, there's a lot of distortion, which makes it really tricky for the Federal Reserve to decide which way they're going to go. But you mentioned the inflation data. Obviously, the PCE is coming out this week, and we will be looking to that to see, is the sticky inflation going to remain, which we kind of expect it to. It's still well above the target and not really coming down, perhaps the pounded theme would not.
Yes, we've spoken about inflation data. The PCE is the consumer-driven data that the Fed likes to use, and it's expected to kick up again. So you'll see it sort of trended lower, but it's bottomed out and it's slightly picking up again. Consumer spending, like in the US, has been strong, although tariffs has kicked in. I've seen some data this morning that although tariffs has kicked in and the US has raked in the most tariffs in the history in the month of August of $35 billion, their trade deficits are still wide and opened up. So it's just points to that the consumers definitely still importing more than they're exporting, although there's tariffs. So it doesn't bode well for inflation. So it leaves Mr. Powell in a tricky situation. If inflation all of a sudden picks up and we see the spike up to about 3%, it's not that the 2% target, and we haven't been in the 2% target for the better part of 4 years now. So it's going to be interesting to see what the users happen. And there's a lot of stuff that we can talk about. Is and you talk about the distortions of AI, but the distortions that we saw from the COVID print of money all the way for the last 5 years, I think that's sort of rolling off, and that's sort of what helped the US economy up. So there's a lot of little intricacies that's gonna start playing out now that's gonna have major impacts, and sort of the distortions that you talk about, like you say on the AI, about the AI replacing people's jobs and job openings is less, that distorts the labor data. So all those things are coming, is coming to fore. It's coming to fore. So we spoke last week, at the end of last week, and say it's all things are just brewing and brewing until something explodes. And I think that's what the market is probably waiting for. It's all very quiet. It's all sort of down in the doldrums. Everything's just ticking along, but along the line, and I don't know where it's going to be. There's a bomb that's going to explode. I'm not sure how that's going to look.
Well, and one of the things is obviously keeping this consumer spending for the PC so inflated. This is exactly what you mentioned. This printing of money that just pumped liquidity into the market during the COVID. And if you look at the excess saving, I think it peaked is just over $2 trillion US dollars, but that is now depleted. I think the last level we read was 22 billion. So that excess savings that was really pumping up this consumer spending is gone. The buffer is done. So you're right. I think there's a bomb that's waiting to happen. It could be the equity markets, which is just at ridiculous levels at the moment. And we're getting interesting questions about, it's no longer whether this is going to be a downturn. It's about how deep is the downturn going to be. And that is an interesting discussion, and whether we could perhaps see another bout of QE coming in to avoid a full-blown disaster. But obviously, the Federal Reserve, they decided to cut. Kganyago, the conservative man that he is, and his team decided to know we're going to stay put through all this. And I suppose that support gave the rand some support, right?
Yeah, so definitely that's given the rand some support. If you see dollar rand sort of didn't go anywhere really, it's sort of stuck at the 1750, 1752, 35 levels, although this morning we're a little bit stronger. But interesting enough, the dollar made a little bit of a comeback after they cut, and euro dollar was up. Euro dollar was up against the euro, against the pound, against all the majors, and the rand didn't respond. So it means all our crosses, pound rand, euro rand, Aussie rand, all our cross currencies are looking a lot better. Well, the rand actually still remains on the front foot, just where it's currently tracking. And in terms of trade, commodity prices this morning is up. Dollar gold's at new record highs. Platinum is up. Palladium is up. Our biggest import of oil still doesn't go anywhere. So it bodes well for our terms of trade. The fact that you just mentioned that Mr. Kganyago didn't cut interest rates in the US, cut interest rates, and they're pointing to more, and we pointing to less interest rate cuts, just widens the interest rate differential between us and the US and the rest of the world, which tracks money into our bond market again. So there's a lot of positives at the moment for the rand, and we won't be surprised if we probably see it a little bit stronger. But for now, we've been advocating for a stronger rand. We've been trading fairly muted in our ranges, and the volatility hasn't been there on the rand. But again, there's a lot of stock maybe brewing in the background that we're not aware about, and you can maybe, the currency, a little bit of headline news, a little bit of bad risk, and we see it 30-40 cents weaker. So for now, it definitely favors the importer. The rand's stable. For the week, we're expecting it to be like in the 1725, 1750 type of range. But again, just keep in the back of your minds, something's brewing, and at any time, something can go horribly wrong very quickly.
Yeah, the data slate is looking pretty quiet for this week. There's some geopolitical rumblings going on internationally speaking, but nothing yet that could shake the market. But it takes one black swan event, and everything can come down like a house of cards. But let's see. Wichard, we will catch up again next week, and hopefully everything still stands.